what's going on with like Silicon Valley Bank.
Welcome to Barry's Bites. Please join our host, attorney and financial advisor Chris Barry.
What happened is that first it was Silicon Valley Bank and then a couple others went down. And the concern was people's money at these banks. And so if it was FDIC insured, then the federal government, through their promises, are going to reimburse. If it's not FDIC insured, then what's supposed to happen is that that individual loses money. And again, that's built into the program. What the federal government has stated, though, is that for the individuals who had maybe greater than $250,000, so it wasn't FDIC insured, the federal government, at least right now, is saying they're going to step in and make those individual investors whole. So that's kind of where we're at now. So short term, what should we be thinking about? Well, if you have more than $250,000 in a specific type of account, like a checking or savings account and your Social Security number, you may want to look at some other options. One of the things like we have right now, our high yield savings account that's offering about 4.25%, it has, for an individual owner, $1.25 million of FDIC insurance protection. Because if, let's say, some other banks do go under, which again, I'm not saying they will, but I would want to make sure that I have this FDIC insurance protection, because we can't depend on the federal government to come in and swipe in, knowing that we took on additional risk by not putting things in FDIC insurance. So that's something to think about short term. Also short term, like obviously this affects the markets. So the markets don't like volatility. They don't like questions. And obviously with what's going on right now, that's raising some questions in people's minds. And then the long-term concern I have isn't so much the markets. The markets are going to come back. The markets react emotionally. There's a lot of emotion going on right now. But the big concern I have is, okay, if the government is going to start bailing out banks or bailing out individuals, how much additional debt is that going to rack up? So I'm looking at this from a long-term tax perspective. We know taxes are going up in 2026 because the Tax Cuts and Jobs Act is expiring. But what about the fact that we're $31 trillion in debt? We just passed a $1.7 trillion spending bill. And now what's going to happen as we're bailing out these even non-FDIC insured investors or these smaller banks? So my long-term concern is with regards to taxes, because we can't keep spending money. We spent a lot during the pandemic. We went from $22 trillion to $31 trillion over about 2 years.